Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Markets Roundup, our debrief on the biggest stories in markets and economics. As I'm sure you've already worked out, I'm John Stepek, senior reporter and author of the Money Distilled newsletter, and I'm hosting today's show while Merryn is out on holiday for a change. It's not me. With me is long-time friend of the show and usefully our government bonds go-to guy, Marcus Ashworth. Marcus is a Bloomberg Opinion columnist covering European markets and is also our go-to guy for all things bond-related. Marcus, nice to see you again. How's it going?
Well, always a pleasure, John.
Never
a chore.
Yes, I'll buy you lunch one of these days.
Famous last words.
Japanese government bonds.
Yeah, all the rage, or not, actually.
What's been going on?
Sure. Well, it's the second largest bond market in the world after US Treasuries, and it's obviously the proud owner of the largest sort of government debt to GDP ratio as well. So the Japanese government bond market has been a backwater in the sense of for foreign investors for many, many years.
No, why
domestic.
Is that?
Well, it's very much owned by the Japanese insurers, pension funds, and particularly the Bank of Japan itself. So It owns a lot of its own debt. So it's one great big sort of money roundabout. Nonetheless, we started to have noticeable inflation in Japan after many decades of deflation and certainly very sort of stagnant growth. But the Japanese economy fits and starts is doing quite well. Yeah. In nominal terms, it's growing at 5%, but you take inflation away, which is sort of 3% and above and below, depending on how you look at it. It's perhaps a problem now that inflation is coming through. The Bank of Japan is very reluctant to raise interest rates, but it is slowly but very carefully. It just wants to see make sure that deflation has finally gone away. But there are some nasty signs, which has meant essentially that demand for long dated debt in Japan, which once was a clamour. All these pension funds used to say, I'm forced to buy US Treasuries because of the yield, because I don't get anything in Japan. Please, can you put yields up? Well, now they've got it, they don't want it anymore. And that's largely because they've got enough. And the Bank of Japan is no longer buying all the JGBs that are sweeping up all the loose bits. They are trying to passively quantitative tighten, which is in essence, they're not buying everything that matures in the sense of rebuying and investing back in the market. They're slowly but very steadily decreasing the amount on their own balance sheet. Well, no one's really there to buy it. Now, ironically, foreigners have been a little bit more active in the last few months because they're seeing yields going higher and they're thinking, oh, let's have a little bit of that. Unfortunately, they've had nothing but bad news since they've been getting involved. But, we really don't have much of a structural demand for the long end of Japan, and we've had a couple of rubbish auctions. We had a 20-year previous week and 40-year this week, neither of which have gone at all well. However...
And just one thing, very quick. So just to be clear, an auction is when the government goes out for the first time and tries to borrow the money, isn't it? Or it says, we're writing a 40-year IOU. Yes, how much are you going to pay for it? It's like an IPO for equities.
Yeah, they're just issuing new government debt across different points on their yield curve from 2 years out to 40 years, and they have a schedule which comes up, and they do anyway. So they've been, as all government bonds are sort of well documented when they will be issuing. The government will be selling more of them. It just depends how many people turn up to buy it. Now, normally you'd expect to see at least 2 to maybe 3, 4, 5, or possibly more times cover. These are well-flagged liquidity events where if you want to buy something, you can buy a lot of it at one time and get a fairly clear and open price. But, 40 years is a very, very long maturity, and it's a very specialist market. It's only really sort of life insurers and pension funds who might really want to buy these things. Anyways, the last couple of longer-ended auctions have done poorly in relative terms, which has brought out a lot of panic, some very sharp yield moves higher. However, one thing of many, many years of trading Japanese government bonds, best part of 35 years and not longer, there is always a saying, it used to be known as the widowmaker trade. Trying to short JGBs is a fool's errand. However, this is because the Japanese authorities are fairly canny when it comes to looking after their own market. And they've looked like they pulled another stunt, which is they've sent around a questionnaire, the Ministry of Finance this is, to all the various different primary dealers, the main Japanese government bond dealers, and said, how much would you like in future? I.e., would you like a lot less? So everyone's read between the lines, they're going to cut all the size of all these sales, and essentially they'll issue much short-dated bonds. And that's sort of worked a bit of its magic. Nonetheless, unfortunately, another auction went badly, so we're back, in the mire again. But definitely yields are a lot higher than they were, seismically higher, and that is a very important international thing to watch.
That sounds good. Just before we get to that, the way I understand it is that one of the reasons demand for long-dated bonds, like everywhere, was high is because investors basically were in an environment where they thought interest rates were going to keep going down and deflation was going to continue to be an issue. And what has happened since COVID and inflation took off is that psychology has been destroyed, and also obviously inflation has gone up, so you now need to get paid for taking the risk, whereas you didn't before. How much of that is the case, and how much is it something more structural? It's like, do these pension funds not need 20-year maturities anymore? Why is that?
All you said is correct. However, the brutal reality is that the Bank of Japan is not buying as much as it used to buy. It owns 50-60% of the entire issuance, and it's trying to reduce that, and there aren't enough buyers to replace it. It's nothing more, nothing less. Demand is lower than supply at the moment.
There's more sellers than buyers.
There's just not enough. There's no buyers. It's just not a question of not that many sellers, but there's just no buyers at all. So you just get to, and often the Japanese government market is moribund. It doesn't occasionally even trade. It's very much by appointment, but it's held by very well-known people. We don't necessarily want to add to anything more at the moment, and that's where we got this situation whereby if the government comes in to try and sell something and no one turns up, in effect, or not enough people turn up, the market just doesn't want to know, and yield goes higher and higher, the price goes lower and lower until eventually the authorities have to do something, and that's what they've sort of done by giving a big signal that they probably might sell some less, but we shall see. Moving
out from Japan, how does this affect the rest of the world?
Right,
the US market, I guess, is the obvious one.
Japanese bond yields and interest rates have traditionally been very, very low. So it's been the main home and source of what's known as the carry trade, which is a hard thing to understand. Basically, what people are doing is they're borrowing in yen and then using that money cheaply to buy higher yielding, more exciting assets like US tech stocks, for instance, or even US bonds. But so a lot of the international flows are dependent on liquidity from borrowing in yen. If all of a sudden that becomes a lot more expensive, as it has been, it unravels a lot of other types of trades. So it is essentially, a storm in Japan can have material effects elsewhere. At the same time as we're seeing a sell-off in US bond yields, particularly at the long end as well, and indeed in the UK. We can come on to the UK in a moment, but principally we're worrying here about the big flows between dollars and Japanese yen. And the authorities in Japan are very worried about, one, the yen weakening too much, or indeed strengthening too much. They just don't want a gradual. The yen is very cheap in relative terms to the dollar, but slowly and steadily they want that maybe to be less so, but they want no sharp moves. So that means no sharp moves in interest rates, preferably, and indeed in their own bond yields, so, and let alone their stock market. So it's all very careful.
This is what happened last August, isn't it, when we had that brief period of panic when the yen got a lot stronger very suddenly.
Exactly.
Because everyone was
really
assuming,
don't like that stuff.
Yeah, okay.
Because everyone, a particularly big export country like Japan, they are planning forward. If you're going to sell lots of Toyotas, you need to know where your FX risk is, and so everything has to be done, preferably in a very calm and careful manner. So sharp moves are not appreciated, particularly by Japanese authorities. But it's because it does upset the apple cart elsewhere as well. And quite clearly, the Trump administration is in the middle of doing trade negotiations with Japan. Japan's government is in quite a rocky place at the moment. So the last thing they want to be seen is manipulating their currency, and as far as the US authorities are concerned. But they obviously are going to have to do a fairly important and probably painful trade deal with the US, because they obviously export an awful lot. Though they're no longer, as it happens, the world's largest creditor nation. That's now been handed across to Germany, according to the latest Japanese Ministry of Finance details. But the point is that Japan sells a lot into the US. Its currency rate has been very weak. It's been very advantageous for its exporters. They don't want that to change too radically.
because obviously the one issue with interest rates going up is that makes borrowing more expensive. So, I mean, we may as well take this to the UK now, because obviously that's where most of our listeners are living, and where their mortgages are and things like that. What is the knock-on impact to the UK, if there is a knock-on impact? Because obviously long bonds here the yields are going up too. What does all of that mean for the public finances, and for what's likely to happen with the Bank of England rate and mortgages and things like that?
The short answer is not good news. But
yes.
I mean, what we're seeing in Japan is very similar to what we're seeing in the UK.
Yeah.
We had the scare with the sort of Liz Truss instance, which was really more down to pension funds and their bond buying strategies called liability-driven investing. I won't go into the minutiae of that.
Thank you, because I've gone into that a number of times on this podcast, and you're one of the few people that actually confirms that is what it was. So thank you.
The Bank of England,
expert here.
The Bank of England confirmed themselves 2/3 of it was down to LDI.
Yeah, exactly.
So there we go.
Oh, yeah.
However, the point is that the scare that we had around that time, October 2022, 3 years ago, has not really been, how should we say, learnt. And now we're finally seeing the knock-on effect in Japan, much, much bigger than the market in the UK. But it's the same basic problem. There are not enough domestic, long-only pension fund / insurer buyers who naturally want very long-dated assets to match against liabilities. There aren't enough buyers in the UK either, because we have our own minutiae of, as you know, of defined benefit pensions, and the requirements for that is dropping because a lot of them are getting closed. The LDI type of buying is disappearing. At the same time as we just got structurally, even demographics, people are not living as long. There is less demand for very long dated debt. The Debt Management Office of the UK Treasury has done a lot to try and get ahead of this, but it's evident that they need to do even more, i.e. sell less long bonds. Exactly as what perhaps is happening in Japan. This is just a very similar thing. It's a structural domestic demand from the big institutions in both the UK, Japan and the US is radically reduced. The US Treasury is sort of getting ahead of it in two ways. One, they're issuing a lot more T-bills, which we don't really do in the UK, and perhaps we ought to do more of. And
just clearly, T-bills are basically just cash, aren't they?
Yeah, they're very short money market instruments which don't offer a coupon, but they are issued below 100, say at 99 or 98, and they mature at 100. So you get your money back by holding it to maturity, and you get back more than you put in. So, this is short-dated funding, which is, obviously banks are very, very important in it, but we don't do as much in the UK as perhaps other countries do. And the other thing that the US are doing is that the Federal Reserve has stopped basically all their US Treasury quantitative tightening passively. They are buying something like $5 billion a month, but they're hardly doing anything. So in that sense, it's not as prevalent a supply-demand issue maybe in the US, bar what's going on with the Trump administration, and indeed what the Federal Reserve is basically saying, which is we're not going to cut interest rates very much.
So basically the Fed has stopped selling bonds. They stockpiled during the QE.
They've stopped reducing their balance sheet quite as much as clearly the Bank of England are still doing in this country. And we've got the highest 30-year yields of all. We're at 5.5%, and then that's costing us, and it costs our financing and our interest rate bill each year is higher and higher, and that's just obviously causing extreme problems onto Rachel Reeves' fiscal headroom or lack thereof. And we are not helping ourselves at the moment. But basically, like Japan, we've got less demand for very long-dated bonds, so perhaps we should sell even less of them, for the moment anyway.
So does that mean, presumably, the idea would be we stop selling as many long-dated bonds and we start selling more short-dated ones, so like 2, 5, up to 10 years maybe?
Exactly, yes.
But my question then is, doesn't increasing supply at that end then push up interest rates at that end as well, all else being equal?
There's a lot more liquidity. It's a much bigger market. It's much more, you have a lot more foreign interest, particularly foreign central banks don't tend to go out beyond 10 years, and obviously a lot shorter. Equally, hedge funds, which are very active, but in beyond sort of the 10, 15 year, that they're going to be very much only in relative value, buying and selling strategies, doing sort of complex trades, but in the net exposure they have will be very limited. So it's really a very domestic market out beyond 10 or 15 years in the UK. totally dominated for many, many years by pension funds and insurers, and these guys have got enough.
Yeah, they don't need
any more at the moment.
Yeah.
So, as I said, the Debt Management Office has done a fantastic job up till now. However, they perhaps need to be even more, or the Treasury needs to come up with a even more aggressive way of changing how we fund. We funded a lot of very long dated and very much inflation linked bonds in the last 20, 30 years, which has been fabulous for us. However, the situation has changed, and this is not where we perhaps have natural demand. We should maybe go to some more traditional and like a lot more other bond markets and issue much more in the 2 to 10 year sector like the US Treasury does.
Final question on this, but given all of this, what do you think that actually does mean for the interest rates that matter to people putting their savings away and people kind of taking out mortgages? I mean, how? Because at the start of this year, the Bank of England, there were people thinking, we might have 3.5% by the end of the year, but that would be the same rate as the current inflation rate, pretty much, and that strikes me as a bit unlikely now. But I don't know, what's your view on that?
Well, we haven't helped ourselves by raising the minimum wage, raising a lot of public sector wage rises, and obviously huge tax hikes, national insurance contribution to employers and things like that, which have forced a lot of things higher. We do have a bump at the moment because of energy prices, which will go away, and there's a number of things which would lead to you think that probably over the course of the next 6 months to a year that inflation will calm back down again. Nonetheless, really the Bank of England is of the opinion at the moment that it doesn't do anything until it's absolutely proven that they have got on top of inflation, and they are clearly more worried about it than perhaps a lot of people in the market had thought, because we expect the economy to be pretty soft. Now, as we know, the first quarter was strong optically because a lot of inventory build ahead of obviously the tariffs. That's not necessarily going to last very long. So growth for the rest of the year in the UK is probably not going to be that great. If it's any weaker than the Bank of England expects, then maybe we'll see the Bank of England be a little bit more aggressive on rate cuts. But they really want to see two things: evident economic weakness, of which we're not really seeing at the moment. There are some worries in the labour markets. It's obviously the statistics we got, quality of them is parlous, so we don't really have much visibility on that, and they're not taking any risks until they feel they've got uncontroversial evidence that we're in recession or something like that, and until they're seeing inflation actually properly turn the corner and go back down again towards at least evidently back towards the 2% target. Anything above 3.5%, which we sort of see at the moment, is no go for them. They're not going to tighten or raise interest rates, but they're not going to rush to. So we might get one in August, but that's looking like a coin flip. So we may get another one before the end of the year. But look, I never would have thought this, but there is a possibility we may have got nothing until next year. But as I said, unless we get some further clarity both on inflation and indeed on how the economy is faring, I don't think the Bank of England is going to be our friend here.
It really is. Great. Well, thank you very much, Marcus. As always, that was extremely enlightening, and very much appreciate you coming on.
Well, John, thanks very much indeed for having me. Always enjoy it.
Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to podcasts. Please make it 5 stars. Also be sure to follow me on X at John_Stepek and Merryn at MerrynSW. Follow Marcus at Marcus Ashworth. This episode was produced by Moses Andam, Summer Sadi and Tala Amadi. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.